What's up, everyone, and welcome to the Daily Macro Update for Monday, August 18th. Taking a look at some of the headlines today, we have Trump announcing a broadening of 50% on steel and aluminum products. We can take a look at those charts here in a second. We also have more data showing that services, specifically in the New York and New Jersey area, continue to decline here. This chart is a little small. Let me blow it up here for a little bit. This is going back all the way to, I think, 2006, 2005. As we can see, it still remains in negative territory, and that's both for expected and current readings. For the business activity, for the services in the New Jersey, New York area, we also had home builder sentiment falling. I hate when they use this word unexpectedly falls. It's like, what do you think the housing market was going to rebound? But taking a look, it still remained near its low levels from the past 3 months. If you go ahead and go back here, this is pretty much the lowest that the home builder sentiment has been, pretty much since late of December or late 2022, in December of 2022, as well as the last time it was near these levels was in April of 2020, near the COVID pandemic downturn. Pretty much the previous time it was near these levels was June 2012. You also had it around here in late 2006, early 2007. And then before that, around August of 1990 and February of 1991, March of 1991. So very rarely does it get to these levels. And so as you can see, home builder sentiment remains very low. But in any case, though, when taking a look at, let me see here, let's go to the housing market. When you go to the different housing supply indices, you can see that these remain in a bullish trend. Really, the sector that remains in bearish trend has been some of the housing demand stocks, right? Like Invitation Homes. This resembles that home builder sentiment pretty clearly there. Another one here is American Homes for Rent, Mid-America, EQR, ESS. Like a lot of these that are essentially stock signals for housing demand remain in bearish trend, while on the supply side, BLDR, like I mentioned before, HOMZ, TREX, Lowe's, Home Depot, those remain in a clear bullish trend. Earnings for Home Depot are tomorrow, as well as Lowe's is on Wednesday. So Lowe's has had a pretty crazy run up so far in August. Month to date, it's up over 12%. So that's pretty interesting, right? You're seeing home supply companies, in bullish trend, while demand side is in bearish trend. And then, of course, on the prices side, those are also in bullish trend too. So things like DR Horton, Lennar, and then the two housing home builder ETFs that my team and I like to track, which is XHB and ITB. So yeah, those are both in bullish trend as well. So that's some of the update there today in terms of the macro data. We covered this last night in the Sunday macro wrap up, which I encourage you guys to take a look at that if you guys haven't already. But taking a look at this week, it's a relatively lighter week in terms of macro data. Some of the key points are later on this week. On Thursday, we have the Philly Fed Manufacturing Index, Flash Manufacturing and Services PMIs, existing home sales, the Conference Board's leading economic index, and then Also, too, on Friday, we have the Jackson Hole Symposium speech by Jerome Powell, which this schedule here says it's at 10 a.m. We'll see exactly when that is. It might be earlier or later. In any case, I'll be going live for that. So I know that the new schedule is Monday through Thursday, but because we have the special event, I will be going live as well on Friday morning for us to do a live analysis and market reaction of the Jackson Hole speech. So if you guys are new to the channel, welcome. If you guys enjoy, macro data in the context of strategic positioning with markets, then definitely consider following there. But it's a relatively quiet day in the markets. You had some things inching up, like the dollar as well as bond yields. If we take a look at the 10-year U.S. government bond yield, that continues higher at around 4.34%. It came down to 4.2, which is the lower bound in our what my team and I have been calling the stagflation ping pong ever since November of 2024. The 10-year bond yield has been bouncing between 4.2 and 4.5%. Every time it rises up to around 4.5. Some downward pressures include the increases of government bond buybacks, as well as growth scares. And then once it gets down to around 4.2%, and then bounces off of that with inflation fears. And so we've pretty much been in this stagflationary environment since then. So I've been repeating this to you guys over the past few videos, but really, if I was to boil it down to any type of single chart to pay attention to, it would be this one right here, which is the 10-year U.S. government bond yield. The reason being as well is because the bond market isn't, or the long end of the yield curve, meaning like 10-year bonds. Well, I guess a 10-year is technically a note, but 10-year notes, 20-year bonds, 30-year bonds, the longer end of the yield curve isn't really controlled by any type of government or central bank. It's pretty much the free bond market's pricing in expected growth and inflation. And so you want to use that as a proxy, right? And so the signals there are incredibly important. While at the same time, you do want to pay attention to the short end of the curve, things like the 3-month, the 2-year, as well as the IRX.P, because these are pretty good signals for whether the Fed is going to cut rates or not, right? And what's interesting is that you've had a little bit of a rise here over the past 3 trading days in the 13-week Treasury bill, bouncing right off of where it was around April of this year. So it hasn't been in any uncharted territory this year. The reason why I'm even showing this chart is because, one, this is typically an early indicator of when the Fed starts to cut rates, and I highly recommend that you guys save this if you guys haven't already. Again, the ticker is IRX.P, the 13-week Treasury bill. But as you can see, in late August, really around early August of last year, of 2024, you started to see this really start to decline, signaling that the Fed was, most likely going to cut rates by 50 basis points in the September meeting last year. And then by the time the meeting rolled around, this was already, pricing in that 50 basis point cut. And so this is a pretty decent early indicator of that. And so far, since late December of 2024, this has remained relatively flat up until recently. But for it to be pricing in a 25 basis point cut, it needs to get down to 40, which, as you can see from here, it's not at that level yet. And so it's an interesting divergence, because a lot of people like to talk about the FedWatch tool, right? Everyone has pretty much heard about this by now. Let me see. Where is it here? Here we go. All right. So as you can see, the current target rate probabilities, according to the CME FedWatch tool, that is at an 83% chance that they're going to cut rates by 25 basis points. But this is a deceleration from the past 3 days. 1 week ago it was at 86%. Yesterday it was at 85.4. Now it's at 83.2. So as you can see, the probabilities for a 25 basis point cut are starting to inch down a little bit, while the probabilities of a continued pause are actually starting to go up. This time last week, the probabilities of a pause, of a continued pause, was 0. Now that's risen to nearly 17%. So you're seeing what the market is trying to price in here, and you can see these wild swings. And so I like to look at this in conjunction with the IRX.P. And yeah, I mean, the 13-week Treasury bill is not signaling a 25 basis point cut as of right now. So yeah, I mean, I still think it's a little too early to call for cuts definitively. I do think, though, once we have the Jackson Hole speech this Friday, we should get a better understanding of where Powell is at on that. So again, we'll be able to break that down in the video on Friday morning. Okay, so that covers bonds. Volatility still remains very low. I mean, under 15. This is a great time to raise cash, especially ahead of a lot of these volatility style events. Now, when I say raise cash, my team and I don't mean like go all into cash. It means you could even go into cash equivalents or some safety types of plays that we like that are also in bullish trend. But you really just want to, start to take profits on things that have been doing well so that you can either buy them lower at the low end of the trading range, or if they're starting to weaken trend, if they're doing poorly or starting to lose trend, even while the S&P 500 is at the top end of the trading range, then you definitely want to degross out of that according to our process. That's not financial advice. That's just following our rules. Interesting seeing Bitcoin continuing to have a little bit of weakness here. I mean, it's pretty much, the price of Bitcoin has pretty much been flat since early July. So the Bitcoin bulls have been a little frustrated there, but the dominance is mostly held in Ethereum as well as Ethereum-based DeFi tokens. And so, if you go and look at the different dominances, you're still getting DeFi and Ethereum dominance accelerating in bullish trend, while Bitcoin dominance, stablecoin dominance, as well as the majority of altcoin dominance, excluding the top 50, still also remain in bearish trend. So it's not altcoin season, it's Ethereum season, and it's DeFi season. So not all altcoins are being treated equally here. You definitely have to recognize that. I believe I went ahead and posted a chart on Twitter here with that. Yeah, so you can kind of see that here. The green line is stablecoin dominance. The orange line here is Bitcoin dominance. And the yellow line is the dominance excluding the top 100. So you can think of like super small cryptocurrencies. So anything out of the top 100, that dominance is also in bearish trend, while you have DeFi dominance here remaining in bullish trend, right? So very interesting seeing how DeFi season is taking over there for cryptocurrencies. And then let's go ahead and go to the S&P 500. The market just closed here momentarily. The S&P 500 closed a little bit in the green there, but take a look at that volume. Huge drop off in volume today. This was pretty much the lowest level of volume since May 9th, it looks like. Yeah, so this was a very, very low volume day. And, with it having a weak green day like this at the top end of the trading range, I mean, this was a clear sell some signal by those who are in our macro investing communities. So yeah, I mean, very low volume day today. It was almost like, I don't even know, like like a holiday or something, even though the market obviously isn't open on holidays. But if it's near a holiday weekend, typically that's when you get a lot of those super low volume days. But very interesting to see that. Definitely want to take note of price action in terms of volatility and volume and all those great things. But yeah, these are your ranges for the S&P 500 going into tomorrow there. 650 at the top end of the range, 633 at the bottom. The biggest loser in terms of the top 10 stocks according to market cap. So, the top 10 largest stocks, the biggest down day today was in Meta on accelerating volume. So that's obviously a bearish divergence, but it still remains in bullish trend though for Meta. Okay, with that, we'll go ahead and take a look at any of the questions that you guys might have. Welcome, welcome. Hope everyone is having a fantastic Monday wherever you are. Are there any ETFs that are safe for the incoming recession? Who said anything about an incoming recession? So, yeah, I mean, there's been a lot of people trying to call, like the recession callers are back in the news cycle again. And when you take a look at market sentiment, it is pretty low from, even though the S&P 500 is pretty close to all-time highs. You still have pretty bearish sentiment out there. And so it almost makes me want to be a complete contrarian and fade a lot of that bearishness. While at the same time, our process takes precedent. But yeah, I mean, people have been calling for a recession, since 2023. I was included in that camp in those early months in 2023, but then, quickly just fell back into my process so that I didn't lose out on the uptrend there. Definitely didn't catch the bottom, but yeah, I mean, at some point a recession will happen or some type of slowdown. People can argue right now that there is a recession in things like the manufacturing sector and with a certain population of the United States, like the bottom 50%, those people might be feeling a recession. But in terms of an aggregate recession where all, wealth classes feel it, all sectors of the market feel it, nobody really knows when that's going to happen, and it's really not your job to try and predict it. It's not my job to try and predict it, and it's no point in trying to position your portfolio in a way where it might happen sometime in the future, because that's a sure way of missing out on a lot of opportunities. So what I would, my best non-financial advice there, Joel, is to just ignore a lot of the narratives and a lot of things that are being said on the news, because at the end of the day, we just want to follow the trends. And then you ask, is United Healthcare a buy right now? So you're concerned about a recession with the SPY, with it doing this, and then you're asking me about United Health buying it right here when it's doing the exact opposite. Yeah, someone on our call actually asked about this the other day, and citing there was like a news headline about Berkshire buying a bunch of United Health around like 369 or something like that. That was a terrible move because they just got chopped by nearly 40%. So I mean, I don't know why they would buy at that price, but no, this is United Health Group remains in bearish trend. So yeah, I mean, if anything, this is a good short still. If you ever see, here's a good rule of thumb. If you ever see any type of single stock being pushed on CNBC, Fox Business, CNN, anything that you see on TV, really, if a stock is being mentioned, even Bloomberg, that's pretty much a paid promotion, right? You have to assume that. Because how do those TV stations get incentivized? by your eyeballs and by, you know, their sponsors. And so anytime you see any type of, you know, single stock being pushed on the mainstream media, yeah, I mean it's pretty much a paid promotion. Thanks, Joel. Appreciate the comments there and the questions. Ricardo, what would it be? What would it take for Berkshire to go bullish in your model? It would take a lot. Yeah. Right now, out of the top 10, Berkshire is the only thing that is in bearish trend. So, yeah. For this thing to go back to bullish trend, let's see. Yeah, I mean, it would have to do some work. I mean, it would need to like get up to like 500 from here. Like 495 to get back to bullish trend. We need to do something like that. And then I know people's initial reaction is like, "Yo, but what if it does that? You're gonna miss out on, you know, 5.72%." Yeah. You see, like our team, we don't try and like buy something because we're trying to catch a bottom. If something is in bearish trend, we're not longing it because we want to increase the probabilities of us continuing to win in an already established bullish trend. If you try and pick bottoms and things that are in bearish trend, you might get lucky and catch the bottom once in a while, but the probabilities of you doing that are low. And you have a high probability of you just catching a falling knife. So this is why I say that. Zoom out a little bit. Let's say that it was able to push past this. Ignore that for a second. Let's say it was able to blow past it in the next, 10 trading days, and it was able to go up, 6% and then break through. Well, great. If it closed through that level on accelerating volume, and then maybe it came back down and retested that 500 level on decelerating volume, well then according to our process, you would buy right there. And let's say it goes back to all-time highs, then I would still be able to capitalize on a 8.68% rise in price. And then if it keeps going higher from there, then I'm just going to continue remaining bullish on it, right? You have to be comfortable with potentially missing out on a little 6% move to confirm its trend so that you can capitalize on the next, 10% or more move. Because it's all about increasing your probabilities of winning. It's not about trying to catch bottoms. Does that make sense? A lot of people just try and like buy things because they're on a discount from their all-time highs. No offense, but that's a terrible process. That's a sure way of losing money. Momentum is a very powerful thing in this market, and if you let it work for you, you're going to have a much better time investing and trading in the markets. Don't fight momentum. Just don't. It's not worth trying to be a hero and call a bottom in something. And I'm speaking this, but from experience. I've lost a lot of money in the 10 or plus years in trying to develop this process with my research partners, and so I'm sure you've experienced that as well. Yeah, I'm not saying that you were saying that, Ricardo. I just wanted to use Berkshire as an example because it tied into another question that I saw. So, um, yeah, the first part was answering it at near that 500 level, but the second part wasn't directed towards you. Chris, does your course teach macro from basics? Yeah, I mean it's not necessarily like a course. It's a string of training modules where you use it kind of like a point of reference, but it's also going to teach you these concepts. Meaning, like if you have PPI come out that comes out or CPI, you can go back to the training modules to refresh yourself because every time you go through them, you might retain a little bit more. But to answer your question, yes. And the entire training modules, they're set up in accordance to all of the monthly data that comes out every single month. And so you can constantly reference it all the time. But to answer your question, yes. It assumes that you know zero about macro. Good question. Small corrections in Spain, Italy, Singapore. Yep, that's completely correct. That's right, Ricardo. Opinion on buying gold now and holding long term. I understand it's up significantly already from this year. Yeah, I mean, gold has lost a little bit of strength here on its momentum. If you take a look at a chart, it's pretty much remained flat since late April of this year. And so I think it's always good at all times to have a little bit of gold in the portfolio. And, at certain times you want to have a little bit more of it. Like, obviously during the past couple years here, I mean, gold has just been on a just diabolical move. But yeah, I mean, pretty much it broke away here um, at the beginning of 2024. And yeah, I mean, hopefully people were able to take advantage of that because, I mean, gold has outpaced the S&P 500, excluding dividends. Um, and there's even places where you can deposit your GLD and they'll give you a yield on top of it. So, I mean, you're not totally, missing out on dividends if you just hold this. But yeah, I mean, I can't give you direct financial advice, but I personally always hold, a small amount of gold. And then during times like right now, I'll be closer to my max position. But I mean, gold should continue to do well. The only thing is that if we do end up having some type of like sell-off event, you have to realize that as we get later into this cycle, the probabilities of volatility rising start to return. You might have some other companies going under. We're already seeing an increase in acceleration in company bankruptcies. The later we get in the cycle, the higher probability of those things happening. And so when those things start to happen, people end up selling things because they have to, not because they want to. And the most liquid asset that most people, as well as businesses, own is gold, right? So they'll sell their gold to raise cash in order to meet their margin call. So I'm not saying that's going to happen tomorrow, but when things start to lose trend, I typically pay attention. And not to say that I'm bearish on gold right now. Our team is definitely not bearish on gold, but I'm not necessarily going all in on it currently. I still want to wait for the trend strength to come back, whether that's breaking out from this or breaking down from it. So yeah, I mean it's just been in this box here essentially for the past almost 4 months now. Got to see which way it goes. But long term, yes. The central bankers and the government will continue to debase the currency, and so that's going to be a constant pretty much until the music stops playing with with all of that, which when that happens, you and I will be worried about more things than, you know, the GLD price going down, right? What is interesting is that, you know, when you take a look at the S&P 500 denominated in gold, um, the the S&P 500 has pretty much remained flat. Let's see. Yeah, I mean, essentially the the stock market priced in gold is at the same levels that it was back in 2015, pretty much all throughout 2017, the pandemic. Yeah. So you always have to remember that when you price things in a currency, in a hard currency that's not subject to fiat debasement, you actually get a way different picture than what's actually going on. So again, you know, your stocks, your Bitcoin, your housing valuation, it's not going up because the actual value is going up. It's because the dollar is being debased there, right? So, yeah. All right, let's go ahead and take a look at some of the questions on TikTok here. Appreciate all the likes. How does Open Door look to you? Let me see. You mean DoorDash? Oh, Open Door Technologies. Yeah, it looks like this has had a decent run up. I'm unfamiliar with this company. It says it's in real estate development. Okay. Pretty small company. Yeah, I mean, it's in bullish trend right now. But yeah, it looks like it's in bullish trend. One second here. Will gold go down? I don't know. We'll see what happens. We are still in a favorable macro environment. So, you know, we could see gold go higher, but we'll see. Do I like UPS? No, it looks like this took it out from its trend there. No, UPS remains bearish. This is a perfect example of something that has just been making a series of lower highs and lower lows, you know, pretty much since May of 2022. So, yeah. Will Bitcoin and others keep rising this year? It really just depends. I mean, If we start to get more recessionary fears and a lack of confidence in the Fed, that has proven to be an environment that Bitcoin does not like, as well as the S&P 500. If you look at different correlations, the S&P as well as Bitcoin are very highly correlated right now. So I wouldn't be surprised if something gets the S&P 500 down, it'll also get Bitcoin down. What's your outlook on if the Fed will lower its rates? I think that a lot of people are too obsessed with the Fed lowering its federal funds rate or not. You have to remember that even if the Fed lowers its Fed funds rate, which is not the interest rates that you and I pay, it can actually, if they get that policy wrong, then the bond market on the long end of the curve, which is mostly reflective of what the rates that you and I pay, like 30-year mortgage rates and credit card APY, stuff like that, auto loans. You can actually have a situation just like we had last year where the Fed lowers their Fed funds rate and you see interest rates for you and I go higher. So the question shouldn't be, what do I think about, if the Fed cuts rates? It looks like they're most likely going to cut rates by 25 basis points. What you should be asking is, do you think that the interest rates that you and I pay will actually go up if the Fed ends up cutting their federal funds rate? And I say that probably will happen, just like it did last year. That's part of the reason why the Fed stopped cutting rates last year, because the bond market was like, don't keep cutting rates. We're going to keep rising in yields. The bond market told the Fed to stop because of inflation concerns. That's why I keep repeating myself with saying, focus on the 10-year bond yield. That'll give you the answer. Is the S&P mainly held up from the Mag 7? Another economist mentioned that, but missed the data. Yeah, I mean, when you take a look at the percentage of stocks above their 200-day moving average, that's at 60%. That's not very much. And then when you take a look at, let's go ahead and we can go to, let me see here. 1 second. Where is... Man, they don't have the percentages on here. I did see a chart that showed that like the Mag 7 make up nearly 30% of the entire index. I'll have to look up the actual statistic. But yeah, I mean, it's highly concentrated. Great question. Do you agree that crypto is tied to the stock market? Yes. I mean, crypto is essentially a leveraged stock market play. Is it reasonable to expect increased volatility going into September, October? I don't know, maybe. I mean, you have volatility at incredibly low levels right now, so there's a high likelihood. But we won't know until it actually happens. So that doesn't mean I'm going to go bearish on the market. But if we have, with what's going on right now with the VIX, sub 15, that's typically where I'm starting to cash in on a lot of my bets that have been performing extremely well. That way I can, buy them lower when they start to have another dip. Paul, when Kasi, in your opinion, which part of the business cycle are we in based on all the combined macro data you are tracking? we are near the late term of this cycle only because, for the first time, a we are seeing a large. Hold on a second. We are seeing a large deceleration in services. So, but all right, everyone, we're going to go ahead and wrap it up there. I appreciate everyone for joining. Good luck out there, and we will catch you in tomorrow's Daily Macro Update. Bye.